I know this is like technical insurance things, but you know what? You do need to learn this, and you will learn it through experience. Trust me. But you got to put yourself in the position to have the experience to ask me, and that's why I love these questions that come up, because I don't remember, like, I'm not going to just come out and teach you something without, it's always better to have an application for the thing, right? And so this is why the mortgage protection thing is really good, because I had it today from Michelle. She asked about mortgage protection. Now Daryl asked about it. So we are running into situations where we really do need, this is a good opportunity to cover it, right? So, you will be in position. Someone might ask you out of the blue, you guys have those kind of policies that cover the mortgage, and your answer is yes, we do, as a matter of fact, you know. And by the way, this is all we were doing when we got started 23 years ago, mortgage protection. That's all we did. So here's a cool application of mortgage protection. So especially if you're doing the return of premium option. So like Term Life Express, it's a 30-year term, right? And so what we used to do is show them an option of paying off their mortgage early, right? And so instead of doing the full, covering the full 30 years, Joe and Mary, wouldn't it make sense to, look at another option? How would you like to pay your mortgage off early? And they go, oh, how do you do that? Well, what we're going to do is we're going to add this thing called return of premium. And what it does is you pay more for it, but you get all your money back. And let's just do it for 20 years. So your 30-year mortgage, let's accelerate the payoff down to 20 years. And let's do it with this return of premium option. So at year 20, you're going to get enough to just about pay the mortgage off. And if you ever look at a 30-year amortization schedule, at the 20-year point, typically it's about half the mortgage. So if your house is $200,000, at 20 years, you typically have $100,000 left to pay off, right? And so if you cover, $200,000 with a regular 30-year term, it's going to cost X amount of dollars per month. But if you do a mortgage protection product with a return of premium option, and you have a 20-year term with the payoff of the premiums almost double in some cases. But then at the end of 20 years, they have enough to just about pay the mortgage off, right? And so that's how we would characterize the strategy as, I know you're paying more, you went from $100 a month to, $175 a month, but here's what you get for $175 a month. Number one, you get covered for life insurance. So if you die, the mortgage is going to be paid off. Okay. But number two, if you live through 20 years, you're going to get, let's just say $175 a month times 20 years. What is that? I don't know what the real numbers, but in all the times we've ever run scenarios, 20 years, they just about have enough to do it. So let's say it's 175 times 12 times 20. So they get 42,000 back. Okay. And, let's just say that's enough to pay the mortgage off. So basically what you've done is you've paid your mortgage off early. So what's the value of paying off your mortgage early? Well, let's take your mortgage payment. Let's say your mortgage payment is, $500 a month, 500 times, I know that I'm being like halfway facetious, 500 times 12 times 10. So that's 60,000. So the value paying off your mortgage early is $60,000, because you don't have to make those mortgage payments anymore. You have $42,000 to pay the mortgage off. So the swing is $102,000 for the difference of $75 a month from 100 to 175. So $75 a month to get the value of $102,000. Man, that's better than putting your money in a mutual fund, right? And so you wiped out, and some of the numbers we were coming up with, gang, with some of these mortgages and the amount of premium for both husband and wife with return of premium, I'm telling you what. Yeah. So, I mean, we do the husband and wife. So it'd be like, $84,000. So that's getting close to being able to pay the mortgage off early. And we would show them the value of bumping up their premium, another 80%, 75%. They would get like multiple six figures back in value. And it was like a no-brainer. So the benefit is to the client, but guess what? Your premiums just went up by almost double, and you get paid almost double for giving them a strategy. Now, there's not a lot of term products that have return premium anymore. So how do you do it? Using a UL. You would use Index Universal Life Express, and you would run Universal Life Express. And if you look at the cash value, typically in about 20 years, you can play with the rates, but you can get it to where 20 years they have enough to pay their mortgage off, right? And so you can make the case that they can pay their mortgage off because the cash value they have in their policy, they don't need their policy anymore because their mortgage, they're going to pay their mortgage off early. So you literally can do it using Smart UL. I'd recommend Index Universal Life Express when you run an illustration. I tell you what, man, if you're focusing, if you have a mortgage protection client, that premium rocks, especially if you're doing it in a UL. So UL is a really good option to get into the mortgage payoff scenario early. Does that make sense?